The efficient market hypothesis is a theory describing behavior of an assumed perfect market. So in this perfect market, securities are in equilibrium. Security prices fully reflect all available information, and security prices react swiftly to new information. And because stocks are fully and fairly priced, investors really don't need to waste time looking for mispriced securities. The efficient market hypothesis comes in three flavors. There's the weak form that says you really can't beat the market by looking at past prices. So what this means is you can look at stock charts, look at past performance, and that's not going to be a guarantee of future performance. So you can't really beat the market by looking at, hey, the market's been going up in the past, we should expect it to go up in the future, or the market's been going down in the past, so we expect it to rebound and go positive, go up in the future. The weak form says you looking at historical pricing data, you cannot beat the market. And then there's the semi-strong version of the efficient market hypothesis. And the efficient market hypothesis, not only can you not use past price information, you can't use any publicly available information. So this is saying you can't look at past stock prices, you cannot look at current accounting information, so you cannot look at filings that the company's made, you can't look at the product markets, you cannot do any type of assessment based on publicly available information and expect to beat the market. And the reason for this is there's thousands of other people that are looking at that same publicly available information, and all of them trying to beat the market. All of them are forcing, every time there's some news, forcing the stock prices to come up to a new equilibrium, so it's really tough to beat the market. And then the third form of the efficient market hypothesis is the strong form. And this says that even if you had inside information, so for example, even if you're the CEO and you have insider information, you can't beat the market. Now, the literature seems to indicate that the weak form of the market efficiency is reasonable. There's not really strong evidence that the market is not at least weak form efficient, nor is there strong evidence that the markets are not semi-strong efficient. Now, there do appear from time to time to be some anomalies that may make it seem that in some period of time that the market is not efficient, but overall, for the most part, the literature, the evidence is fairly consistent with the market being either weak or semi-strong efficient. And of course, we really can't test whether the market is strong form efficient, because that would require us to get a sample of insider traders, and since insider trading is against the law, you can go to the penitentiary for that. It's really hard to get a sample of people that would volunteer for an academic study to test whether or not the market is strong form efficient. Quick concept check. With semi-strong form of market efficiency, A, B, C, or D. A, all historical information on past prices is reflected in the current stock price. Or B, all currently published information is reflected in the stock price. Or C, all insider information is reflected in the current stock price. C would be the case for the strong form market efficiency. A only would be the weak form, and A and B would reflect the semi-strong form. So if you chose D, you got it right. Now, although there's considerable evidence that supports the concept of market efficiency, there is some evidence that perhaps markets are not quite as efficient as we thought. At least they're not efficient all the time. Behavioral finance is a body of research that focuses on investor behaviors and how this behavior impacts investment decision and stock price. So advocates of this are commonly referred to as behavioralists. And for a really good lecture, I've got the link here, and I'll also provide it in the lecture materials, a lecture by Nobel laureate and Yale professor Robert Shiller on the role of psychology in finance. And there's a number of investor behavioral biases as well. One of these is regret theory, and again, I've got a link to a Robert Shiller lecture. Regret theory deals with emotional reaction people experience after realizing they've made an error in judgment. And then there's herding behavior, investors kind of chasing out and doing what everybody else is doing. And there's also evidence that people put particular events into mental compartments. In other words, maybe forgetting about their losses and only remembering their wins. Prospect theory suggests that people express a different degree of emotion towards gains than losses, where losses are much more painful than gains are joyful. And anchoring is the tendency of investors to place more value on recent information. And in the next section, I have a series of videos on different types of investor biases, and I would like you to watch them and think of a situation where you demonstrated one of these behaviors in your own life, whether financial investing life or on the job. But before proceeding to the next section, a quick closing concept check. A market that establishes correct prices for the securities that firms sell and allocates funds to their most productive uses is called a That's right, efficient market.